Today we're going to learn a little bit about predatory lending, a practice that is prevalent throughout the United States and can exist in many different loans. This video is going to focus mostly on big banks financing payday loan businesses, but publicly not wanting you to know that they are a part of this business. Big banks like Wells Fargo will say publicly there's certain consumers that we're not comfortable lending to based on their high-risk borrowing profile. But if you come to us with a business plan on how to receive 500% annual interest lending to those people, we are all ears. WFAA.com has written some great editorial pieces on the payday lending business in Dallas and how the big banks are still quasi-participating in redlining, even though it's a lot more subtle than it used to be. Diabolical and wrong. Wells Fargo, other banks finance predatory lenders that can charge over 400% interest in minority communities. You have the big banks like Wells Fargo, Bank of America, and others that need certain criteria met in order to provide personal loans. Unfortunately, there are a group of people who do not fit their criteria as a borrower to receive the loans. This group of people still needs loans, so what happens? An entire industry is created to help provide loans to these borrowers. They're higher risk, so it's only fair that the interest they pay is higher to offset the risk. But how much risk is fair and how much becomes absolutely predatory? We'll explore this question in today's video.
In our ongoing investigation, we've been presenting evidence that banks make relatively few loans to people that live in the largely minority communities below I-30 in Dallas.
But it turns out that some banks are quietly making some big loans in these same neighborhoods, just not the kind you'd expect, and maybe the kind they wouldn't want you to know about.
The big banks run our country. They control our entire economy here in the United States. Really think about what runs our economy. It's the ability to borrow. Without the ability to borrow, our economy collapses. 2008 being a great example. It shouldn't be surprising then that the communities that are low income, low business growth, and higher risk borrowers are the areas that banks don't lend to. It's the chicken or the egg problem. What came first? Bad borrowers or banks creating a system that sparked the payday lenders? One of the most impactful elements of America's history was the practice of redlining. What's fascinating to me is how I wasn't taught this in school, but as I've gotten older, it's become obvious that this still has a profound impact on society in America today, and I'd argue a central element to really understanding socioeconomic elements of society. I talked about redlining in a previous video, so I won't go in detail here, but the practice basically created a natural divide in a city between people who are seen as good borrowers and bad borrowers. Unfortunately, back then, given the prevalence of racially driven motives, certain groups of people were given unfair treatment that led to being categorized as a bad borrower, when in fact, it was more of a problem with the system itself. Redlining was a key contributing factor to the poverty cycle. We're still seeing the effects of the poverty cycle today in poor communities. Because residents in poor communities generally have poor credit, shaky work history, and really high personal expense to income ratio, it's hard for these people to get loans. In comes the businesses that are as predatory as fake gurus on potential paying customers. Sure, they meet a demand, but that's like going to a pack of hungry lions with food and asking them, how much are you willing to pay? The market rate for this nice 12-ounce rabbit is $9.99 per pound. I'll sell it to you for $50 a pound. If you're hungry and don't have food, the supplier can charge 100x the price and gouge you knowing that you need food. The same can be said about money. If someone needs money today for rent or to keep the lights on or to put gas in their car, the person with money sets the market.
And now people who are desperate go there to get economically exploited and preyed upon.
There's always going to be an argument of where does the responsibility lie. Do only irresponsible people go to payday loans? Should there be a market rate and a cap on risky lending? Should we determine what's fair and not fair for a private business making a risky loan? This news article and the corresponding videos focus on I-30 in Dallas, but let's check out Vegas, the city I live in. With over 2 times as many payday loan stores than there are casinos, you'll find a payday loan storefront at almost every major intersection in Las Vegas. The payday loan industry in Nevada is about $500 million a year. You know how lucrative crypto speculating can be when Bitcoin or Dogecoin goes up 20% every month? That's a fun investment, but do you know what can make you even more money? Payday loans. According to the Center for Responsible Lending, Nevada has no meaningful regulation of payday lending. There is no cap on how much interest lenders can charge. Among the highest in the country, the average interest rate in Nevada is a whopping 652%. The national average is around 400%. Even fake gurus can't promise a 652% return on your investment. Imagine having $100 and then just a year later, that $100 is now $652. The reason why this article is both sad and ironic is that banks like to present the idea that that they don't want to be in the business of providing predatory loans to people, but then you find out that they're the ones financing the businesses that charge the predatory rates. It's literally like someone promoting the idea of a clean marketplace where fake gurus don't exist and get-rich-quick claims aren't allowed, yet provide all of the software and marketing for the fake gurus. It's like, hold up, I thought you weren't in this business. Our review of public records filed with the U.S. Securities and Exchange Commission reveals that almost 20 banks are funding or have recently funded predatory lenders. Some are big banks like Wells Fargo and Bank of America. Others are based in Texas like Texas Capital, Bank of Texas, Veritex Bank, TBK Bank, Amegy Bank, and Independent Bank. From an outsider's perspective, to me it seems like the payday lenders created the problem and then justified the predatory solution to the problem they created. I understand that people going to a payday lender are in need of quick cash, generally don't have good credit, and are at high risk to bail and never pay off the loan. But I'd like to argue that the payday lenders incentivize borrowers to not pay back their loan. Given that the typical customer isn't driven by their credit score, there is no recourse for the lender. That is why the interest rates are so high. Borrowers don't really care if they pay back the loan because a hit to their credit just isn't life-changing. Their credit probably was already low. I think that payday loans charging a reasonably fair rate would actually increase the amount of business they do and would incentivize the customer to pay back the loan. Look at credit card companies. They charge 20 to 30% on their cards, are billion-dollar organizations, and everyone uses them. Most human behavior comes down to incentives. Once you understand someone's incentives, you can generally predict their behavior. As a result, most borrowers renew or reborrow the loans. This explains why the CFPB found that 80% of payday loans are taken out within 2 weeks of repayment of a previous payday loan. This is an industry that recycles people over and over through the system because of how challenging it is for the borrower to escape the predatory nature of the loans once they enter into the cycle. At some point, the borrower is going to feel like they're being taken advantage of and just walk. My argument is that these lenders acting more like a credit card company and offering more reasonable terms would allow for these borrowers to eventually pay up, because they'd actually have a chance to pay off the loan and exit the cycle. After 1 or 2 rollover periods, what is their incentive to pay off the loan? They have bad credit and they can tell they've entered into a cycle that is nearly impossible to exit. A little hit to my credit? No biggie, I'm not going to pay off my loan. And then the payday business complains about borrowers not paying. Here's a quick and simple rundown on why payday loan interest rates are so astronomical. A borrower needs $500 on a Monday in order to pay a bill. They go to a payday loan business and ask for a loan of $500. The lender confirms that the borrower has a paycheck on the way and confirms that the loan represents 25% or less of the monthly gross income of the borrower. The lender gives the borrower $500 and writes a check to themselves in the amount of $500 plus the interest rate. Let's go with a simple 20%. The check is written for $600 and is dated on the date of the following payday. This is the lender assuring that they will get paid. The payday comes and the borrower does not pay down the $620 in full. The lender then rolls over the balance and adds their 20% interest rate to the current balance. Without getting too into the math, just imagine the balance continuing to grow at a 20% rate every 2 weeks. This is how borrowers can end up paying $1,500 for a loan of $500 just a couple months before.
And so I would have to, get a payday loan just to pay rent.
Leon Cox knew he needed $500. What he didn't know was how dearly it would cost him.
With a payday loan, it's never really worth it because you'll get $500 and end up paying, anywhere maybe $1,500 back.
Were you surprised by how much you had to pay for that $500?
Of course.
Credit cards are often seen as super high interest and a last resort to use in an emergency. Most credit cards are going to be around 24%, and I want to make the math simple in my example. 24% is 2% per month. If the same borrower needed $500, they would pay only $10 every month in interest on a credit card. In the previous example, going to a payday lender could result in a $1,500 charge just a couple months later. With credit cards, there is no rollover. Sure, there's high interest, but over the full year, you may pay $625 to fully pay off a $500 expense. The same $500 expense with a payday lender could result in a multiple $1,000 expense if the rollover happens multiple times. I consider myself lucky to not ever have to deal with payday lenders. It's an industry I didn't know much about until looking into this article further. Personally, I don't even charge late fees to my renters because I find late fees on renters to be pretty predatory. I've always been at odds with the late fees and charging people extra because they're a day or two late, which is not even really late. I pay my mortgage on the 7th of the month, so as long as I get the rent by the 7th, it's irrelevant to me. Saying that, you probably can tell my position on the business of payday loans. I think it's insane that this practice can exist. Humans can land on the moon and create self-driving cars, but we can't figure out how to help people in financial need without sending them down a poverty cycle loophole. Once you really understand how the banking system works, you start to understand why it's so incredibly difficult for people at the bottom of the food chain to escape the poverty cycle. This is a game where the winners win and the losers struggle. It's not fair, but at least now with YouTube and access to information being readily available, you can only hope that people will figure out a way to leave the cycle. Hope you enjoyed the video. Thanks for watching.